Hello and welcome to Vox Markets. I'm John Hewman and I'm joined today by Kiran Morzaria of Cadence Minerals. We'll shortly be answering some of the questions you've sent in. Before that, Kiran's going to update us on what's been a very busy period for the company. Over to you, Kiran.
Good morning and thank you for attending the investor presentation and Q&A session for Cadence Minerals dated July 2022. The format of this is going to be, we're going to go through a presentation and reflect the recent updates that are going or have undergone in the last 6 months, and also the updates from Amapa, where we are now and what's happening at that iron ore asset that we're developing. So the next slide is disclaimer. Please read it at your leisure. It is an important part of the presentation, but I'm not going to go through it in detail. I think this is important to reiterate our strategy. We are an investment company on AIM. We do invest predominantly in minerals and metals. We all the way from exploration through to production. We look at deriving capital growth from that investment. So either driving value through taking it through the development stage, or in fact, as you've seen the more recent announcements, when we've held that asset and then resold it at least three times its value, and taken equity in the buyer. Our origination, structure and representation, you can see how we act in terms of how we invest and how we take part in management and how we influence management and set where we can to develop this asset to deliver the greatest value to Cadence shareholders. And the processes below: identify, invest, assist, monitor, and if required, retain it. If we want to see there's more value to retain that investment, we will. If not, we can exit after that strategy and reinvest it in new assets, thereby delivering capital growth to our share price. So how's that delivered today? I mean, it's all very well saying that, well done, you've gone and that's your strategy. How have you executed it to date, and how have you delivered value? So I suppose, as you know, that there are two parts of our portfolio. We have public investments and we have private investments. So the returns on public investments on a year-by-year basis are there for the last 3 years, and 2022, which has not been so great, as we all know, is year-to-date is down 41%. But prior to that, the cumulative, the last 2 years, 21 and 2020, we were talking about a 220% return on our public portfolio, and we view that in each year, we view that as an excellent set of returns in our investments, and solidifies our belief in our investment strategy and showing that we are delivering returns on our public investments. I think cumulatively over our portfolio delivered, I think in our last set of accounts in 2021, that was around a 300% return cumulatively over the life of our investments. In private investments, I think we all know Amapa Iron Ore. It was previously valued at $660 million, and had a substantial turnover, 178 million. Sorry, not turnover, profit, 178 million. Cadence acquisition has cost us $6 million for 27%. So you can see the potential upside there. Of course, we have to go through pre-feasibility study, DFS, and of course, once you get to production, that's when you do see that value, and that's when cash flow starts to flow. Or of course, you could dispose of it before then. The other two things, in exhibiting what we've done with our private investments, which has been a strategy for this year, is we've had two assets. One was the lithium asset that we got involved in a few years ago, and it was originally an Argentinian lithium deposit. We traded that into an Australian lithium prospect, and we invested about £800,000, and we reached a sale agreement, and actually we completed that sale, in which we'll get a first £1.88 million and get up to £3.72 million in stock in the company that's bought it, called Evergreen. So that, and then in conjunction, Yangibana Rare Earth, which we have had an investment of £0.9 million, that has been sold for £5.1 million. So as you can see there, those two are examples of where we've looked to get 3 or hopefully 4, but in this case around just over 3%, three times our value of investment. So the summary of, there's a summary of what we've done and how we act, and there are the results in terms of return. I think this has changed from the last time. Those in grey are what we'll call private investments, and those in red are now either public investments or be heading towards public investments. We know European Metals, we have 8.1% of that. The PFS economics are 1.9 billion, and Hastings Technology Metals, we sold that, the Yangibana asset into that, and we'll get 5.1 million pounds of stock in Hastings Technology Metals when that completes. Evergreen, that first 1.8 million is going to be 13.2% of Evergreen, which is intending to list on Australian Stock Exchange. We'll talk a bit more about Evergreen. And Amapa we know, and Mexfit is a JV with Ganfeng, which we can go through in a bit more detail later on. So iron ore, guess what we're going to talk about? Amapa. I think you've all seen this this slide. It's showing its history, so its location, the value 660 million, operating profit 171 million. The last mineral resource, which we intend to update further, is 185 million tons. Life of mine previously was around 14 years, and 5.3 million tons of iron ore per annum. I'll talk a bit how that's progressing and what we think we'll be able to do there, but that's where it is now. We own 27%, and we have a first right of refusal to go to 49%. That first right of refusal, although not defined, I estimate that remaining percentage would cost us between, as I said before, around $24 and $30 million to go to that if we choose. So where are we with Amapa? This year has been, first of all, we signed the deal with the banks at the end of last year, which basically was the legal point at which we would start vest our ownership. The ownership came a bit later, but that's only because it was processed rather than any predicament. It was, as I said at the time, it was like owning a car. You've bought the car, you filed the V5, and the V5 will be forthcoming, so it's your car. So we knew that by that time we were going to own the asset, and we really started focusing on delivering the PFS. Where are we with that PFS? Now, the PFS is a complex document. Typically they can be around 600 pages long. Not that's a measure of complexity, but you have to go through the engineering, costing, safety. So at this point in time, we've completed the engineering costing across to PFS standards on the key areas that are plant, rail, and port. We're optimizing some areas there because we think we can trade off some operational efficiencies and achieve the most cost-effective engineering solutions across those areas. We've also identified, and I was out there last month, rather, in June, and we identified that there were some opportunities in the mineral resource estimate and ore resource reserve estimate to possibly improve the mineral resource, and of course upgrade it entirely, to a large part of it, to ore reserves. And so that's ongoing, and we want to get that done as soon as possible. And that's why I've said that we're going to release an updated mineral resource estimate before we release the PFS, although the PFS is largely complete. The one aspect that is taking longer is the tailings dam design is ongoing. Regulations, particularly some regulations brought out in February in terms of closure of tailings dam, has meant that we're having to look at how to best optimize the closure of tailings dams in Brazil. So these, we have to take care that we ensure specifically the sensitivity and the impact of tailings dams failures in Brazil that have occurred. This is a large piece of engineering work, including taking samples from the tailings dam, taking them off to see where how they fail, at what levels they fail. So it's a really important part of work, and that's just taking a bit longer, partly to do the change in legislation that occurred and was passed in February this year. We're continuing to work on the tailings dam maintenance and permitting, really important, and we're continuing to work on environmental licenses, and we've started our shortened baseline studies required to reinstate the old environmental licenses. So that's where we stand with Amapa iron ore. What we look forward to delivering now is a revised MRE and mineral resource estimate and ore reserve estimate. followed by the PFS, and then you would start your DFS after that. And I've got shown some ideas of timings in the next slide. I think you've seen this. I haven't changed this since the last presentation. So I think the important thing is that we own everything through geology, mining, processing, rail, and port. I think one thing that we will be doing in our mine plan is that last bit we talk about a transshipment. It looks like that we're going to be doing effectively loading a Capesize at our port, but half loading it, then taking it out to the Amazon, past the Amazon Delta, and at that Amazon Delta, past the 11-meter depth hump. That's the only depth. That's the depth of the Amazon Delta. Take it out past there, and then fully load it. This allows us to achieve a lower cost in terms per ton of shipment to China. I think that really you will have seen this beforehand, and we are, I don't think there's much else to say there. So people ask the timing, what's going to happen and when it's going to happen. Obviously, H1 22 has occurred. The 2.5 million equity investment has occurred beginning of the year. We then further invested another 7%, which we were due to invest as well. Obviously, pre-feasibility studies have started, and that's ongoing. Iron ore shipment did start. Unfortunately, as we've seen with the markets, particularly the impact of the war of Ukraine, plus some other things that occurred the 2 previous years, supply chain issues with COVID, inflation of soft commodities, has meant that the Handymax vessels that we're using only for the stockpile have become restrictively expensive. And so at the moment, we only ship one vessel, and we've paused the iron ore shipments until there's substantial profit to be made from the shipping of the remaining 1.2 million tons of 58% material that lies in the port. And as you say, we're doing the maintenance, repair, and licensing of the assets, and particularly the dams, and the licensing of environmental licensing, as we've just mentioned beforehand. Mineral resource expansion. Well, what does that mean? I think, well, this is actually in relation to a historic joint venture with Great Panther Mining, which has progressed really well. We are, both parties agree in principle that those JVs still exist or in place. Therefore, they can mine areas of gold from our areas, and we can mine areas of iron from their areas. So what we will be doing, they won't be part of the pre-feasibility study, but part of the definitive feasibility study, is we'll be taking and collating that data, verifying it, checking it, auditing it, seeing if we need to do any twinning or subsequent holes, and then if that stacks up as a mineral resource, adding that, and an ore reserve, adding that to the mine life and mine plan. And that's not a quick process. It's not 2 or 3 months. You can expect sometimes a mineral resource mineral resource audit, including possibly some twinning and drilling, to take 6 to 8 months. So it's going to be within, or 6 to 9 months. That's going to be within the DFS stage of our work. But that is a potential expansion of our mine life. So instead of having around a 14-year mine life, you could be talking about a 20-year mine life, or even, and this is a 25-year mine life. But those are that would be a substantial improvement to the NPV, of course. Increase the internal rates of return on capital investment. So overall, a good economic outcome. But at the moment, we can't say how much it's going to increase it by. So once we have that, once we start that work, we'll update the market, and update the market when we get to new mineral resource estimate or something similar. Lithium and rare earths, I think that's really, we can go on to, and this has changed since I last presented, because of course, lithium carbonate rocketed up and is still high. And I think the most important thing is most of our assets really used 11,000 tons per lithium carbonate for revenue calculations, which is still substantially below current prices. So we talked about, we used to have these assets called the lithium supplies and lithium technologies. We completed a sale of these assets into a public company, which is not listed at the moment, called Evergreen. So it was apologies at the top there. We had a 31% joint venture partner with Lithium Technology Supplies. We have sold that stake, our 31% stake, and all the other shareholders have sold it into a company called Evergreen, which is to be listed. The initial stage for £1.81 million will get us 13.2% of Evergreen. And then if they're successful in targets, which is in effect proving a substantial resource, and then taking it to a DFS or an economic study, we can get paid in various tranches a further monies, taking us up to 3.8 million pounds of value. So that will be paid in equity. Now, one might say, well, look, if we look at the returns, we put in, as we mentioned before, sum of money, and that's gone up about 2 or 3 times, over 3 times. But why we like this asset is it's right next to the core lithium asset. We didn't want to invest capital, and that's why Evergreen are going to spend a minimum of $4 million just exploring this asset. And it's 2 kilometers north of core lithium's asset, and particularly their Finniss lithium pegmatites. And that is a significant pegmatite deposit that has probably the next hard rock producer out of Australia. It's very close to infrastructure, being Darwin's port, and our assays that were completed before the sale, have delivered some very interesting anomalies, which is one of the reasons that Evergreen has got involved, and its strategic location. Now, I would add that that value of core is $1.1 billion at the moment for that asset. I think it's about 13 million tons of lithium oxide at about 1.3%. If I've got that quite right, but shows what the potential value of an equity stake in a public company could mean to Cadence. And I would add also that when I last presented this, which was in April, the market cap of core was 2 billion. So you can it's nothing because fundamentally it's changed with the company. It's just that the market, given this inflation environment and the risk off bearish market, people are selling assets of this sort, to liquidate their money, to put in cash rather than leave it in equity. But so we see some real hope here, and we certainly see, once they start drilling and exploring, we'll be reporting that. And we look forward to their listing this year. European Metals, I think really nothing has changed there since we last spoke. We've got 8.1% of it. The valuation has gone down, and that's as a broader trend within the lithium market, despite the lithium price being high. We're seeing that they're down about 40% this year, and that representing our returns this year. But fundamentally, the project hasn't changed. It's progressing through its DFS. It is strategically located. The NPV value is the same. So it's just, again, an equity sell-off where people have gone risk off, but fundamentally the project is a good project. And even at these prices, we have still got substantial profit baked into the equity position. Hastings Technologies. Again, one of our targets for this year was to take some of these private assets and try to show value through an acquisition, through an equity swap, rather than sitting at the tail end of a mine life, which is not going to get mined until year 10 or 12. And that's what we've done here successfully. We agreed to sell our 30% in some joint venture areas that were not going to get mined until years 12 to 13, 12 to 15, and brought that forward and put it into equity, or will be transferred into equities of Hastings Technology Metals. So we've agreed to sell our stake that we bought for 900,000, or invested and bought 900,000 pounds worth of cash and equity, and we sold it for 5.1 million, which will be converted into Hastings Technologies Metals, and therefore we'll have the exposure to the entire project, the entire $1.1 billion worth of project, and it's in construction, so the risk is substantially limited in terms of it now becomes execution risk and financing. So I think we're really happy with both of these, Hastings and Lithium Technologies, showing that we can take something that we bought for substantially less and have made more money, certainly on paper and on balance sheet, and it will reflect in our P&L this year as well. And the Sonora lithium project, probably this is the one that has had probably, as you know, we've got a joint venture partner on the Sonora lithium project in those light green areas where we would be mined in the later stages of mine life, and certainly not to start off with. And that's nothing to do with anything to do with the decision by Amapa and Sonora when they did the DFS. It's just geology, right? So effectively the Fleur pit has a very large overburden, while La Ventana has none or very little. So therefore it will get mined last, and that has essentially what remains the case. Now, of course, what's happened is that Ganfeng, the Mexican government has passed legislation to effectively make lithium a strategic metal, and it would be owned, any new licenses will be owned by the state. Now, this has already got a license, it's got an exploration license, it's got a form of an extractive license because it's been testing. And our position is the same as Ganfeng. These licenses are still valid, and they're worth developing. Again, I think there's some lobbying and occurrence to occur so that get some clarity around it, but that is up to Ganfeng, as they are the primary drivers behind this. And we'll update the market as Ganfeng does of any significance and what's going to happen with Sonora lithium. So I suppose one of the things that I put in the targets for 2022 is what we should be looking to do. I think the one thing that we have achieved is that we've got through the further value creation from our non-core assets, which we talked about as Hastings and lithium, achieved those goals. The restart of iron ore, yes, that started, it's currently paused. And then the rest of the three things, I have every confidence that we, certainly to the first two, that define the 22% of first right refusal, which we talked about earlier, how much will it cost us to get to our 49% if we choose, and the completion of the pre-feasibility study. Whether we get the resource expansion done in this year will be dependent on the level and status of data, and for example, if we require twinning and further drilling. But I certainly think that 3/4, or more than 3/4, 4/5 of those targets will be achieved during this year. Well, I think that's the end of my presentation. I'll try to make it brief as possible so that we can allow some time for questions that have come in during the last day.
Okay, thanks, Kiran. Lots of progress being made there by the sound of things. Let's turn to some of these questions now that our audience has sent in. I guess the best place to start would be the big picture before we go into some specific questions about some of your key projects. This is a very interesting question. Cadence appears to be executing well on targets laid out at the start of the year. What do you think the market is missing, given the potential of the assets and the discount the market is attributing currently?
So first of all, as an overall statement, the market in the small cap or relatively small cap and in the mineral resource sector is very bearish at the moment, with companies of similar size and risk and commodity exposure dropping in market cap, despite there being no material difference to their projects. And we can look at Core, or we can look at EMH, both of, one is down 40%, one is halved. I mean, I think the position is that, look, even if you release an announcement that improves the value, in the case, let's say for the value of Cadence, e.g. the last two announcements where we've converted things that have been at a lower value on our balance sheet to a multiple of, to multiple sale and getting, increasing the value of our balance sheet, it really makes no difference. In fact, it acts as an opportunity for shareholders to sell out through liquidity. And that is typical, that's typical across the market. And I think, we've seen further some commentators, such as Justin from Vox Markets, stating the same thing. But ultimately, this market will change. If we look at where we are in terms of lithium and rare earth minerals, as we see a turn in the market and it becomes a more bullish market, these materials are still needed for the driver for the electrification of vehicular transport. So they will come back. For example, EMH is down, but ultimately nothing's changed. It's still got a $1 billion, $1 billion NPV. That hasn't changed. And so it's just the market really getting a risk-off basis. Look, what we will continue to do, and when we see that change in the market, we expect that to change our market capitalization and our value as well. But we'll continue to market the company, the same level of veracity and engagement, and continue to deliver on our stated objectives for the year, which we've done. And I think, as they say, value will win out eventually.
I guess just a case of sticking to the plan then.
Yeah, deferring the plan and panicking in this type of market really doesn't. You're likely to make a wrong decision by an artificially low market.
Yeah, absolutely. Let's talk through some of the specific plans. Lots of questions about Amapa and Sonora. The first question about Amapa is what your intentions are for your stake. Are you planning to increase that stake? Are you, and if so, how will you finance it? Are you looking to potentially bring partners in? And there's a question here about the potential of an IPO for Amapa specifically. Is that still under consideration? What's the intention around the stake, basically?
So, so we have an opportunity to increase our stake. We haven't committed either way at the point in time. We will always look at the investment and as it develops. So, of course, the PFS is a critical point now, and we look at what is the cost of capital for us to either raise or sell some of our assets if we can for cash, and then reinvest. And is that trade-off going to result in a much better return in terms of capital growth? So that's what we have to look at it. So, for example, if the NPV was much lower than we expected, it might not be worth investing and just keeping our 27% and find a partner to take the rest of the stake. But that doesn't. Decisions aren't made now without the full information. So the PF is really important in that decision process. And once that's completed, of course, we have an idea, but once it's completed and published, we can be far more public with that decision, I think, and what that decision would be. I think the next thing was about an IPO. I mentioned this possible as a solution to raise equity for the capital construction of Amapa, because you're going to be you're going to have a capital expenditure in the hundreds of millions to reconstruct the plant, railway, and port, which is typically, if you were to reconstruct them new, you'd be in the $1 billion mark, and of course we expect that to be much lower than that, as I've mentioned before. But only a portion of that would be capital expenditure, would be debt financing, maybe 70%, and the rest would be equity. Now, Cadence could contribute it in its current state and raise capital to contribute to that equity. Of course, that's a while away, but the other option would be, of course, to list it and Cadence retain its 27% or whatever percentage it ends up with of the asset, and then list it into a new vehicle, which would raise money to build that project. It would raise equity. So there would be a dilution on our equity stake in Amapa. So they both are dilutions. But I think the most important thing is that often when sometimes assets are stripped out, effectively they are fully exposed to the public market, you may get a better valuation for your shares, and you'll certainly have a mark-to-market valuation of your shares rather than a balance sheet valuation to shares. So we all consider all these options. At the end, it's all about return to shareholders. But I would add, it's not going to occur soon, even if we decided to do it, because it typically takes up to 6 months to get a listing done. And we certainly wouldn't consider it until we've completed the pre-feasibility study, which would form the basis of the technical competent persons report required for listing. So all these things are always in our mind, but we'll trigger them if we see there's value to do so.
Yeah, absolutely. I mean, just in terms of the PFS and the DFS, I mean, this is a question that people have asked. It's something you alluded to in the presentation. Perhaps it's worth reiterating what sort of timescales of that might be.
Yeah, and I think the PFS, there are two areas there that we talked about in the PFS that had occurred, which we were looking to improve the mineral resource estimate and the ore reserve estimate above our previously 185 million tonnes. We see opportunities to do so. So that will, improve NPVs and improve the size of the project. So we're certainly looking to do that first, and that was, identified in the last our last visit in June, and so that's extending the PFS timeline slightly. In addition, I did mention the February period, the February time where the legislation had been finalised and changed in Brazil in terms of dam. As a result of Bermudinho and the dam failures, in particular Bermudinho and the previous one, that has resulted in a change in legislation, which we're having to reflect in dam closures. So that's just taking a bit more long time, dam closure strategy, which is taking a bit more time to complete. I certainly expect, but if you look at the rest of it, it's all almost there. If we look at all the engineering and the costing for all the major infrastructure, plant, rail and port, all that's done. It's just really, making to see if we can optimize that mineral resource to get more mineral resource out of it, optimize it to get maybe a better grade out of it, and on the closure front on the TFS is make sure that that's designed within the new Brazilian standards. So those two variants are the things that are really outstanding. So once that's completed, I'll give a timeline when I have those very clear understanding of when those two items are near completion. But then once we've completed the pre-feasibility study, it takes typically between 9 and 12 months to complete a DFS. And that really depends on the recommended work from the PFS. But 9 to 12 months would not be an unreasonable target subsequent to the publication of the pre-feasibility study.
So, it sounds like we've got a clear roadmap for that absolutely. Process.
And sometimes you finish a PFS, then you go out to tender to get your DFS manager, so that might add another 3 months. So there's a process, because the DFS is ultimately the document that allows you to get bank finance for the project.
On a related issue, we've got a couple of questions about your relationship with Great Panther and a potential deal to extend the mine life, which you would imagine is part of that process of obtaining the PFS.
Well, I think I've never said it's going to be part of the PFS. We are basing our PFS on a resource that is within our areas. I think there lies an opportunity in the DFS. What we have done is we've established with both parties that the JV in principle exists and is in full force, so they can mine gold from our areas and we can mine iron from theirs. We're in the process of exchanging all the data. And once we have that data, as I said beforehand, we need to audit, check it, review the samples, maybe send off some of the samples, quartering the cores to send those samples to verify and audit it, and then possibly even have to do some drilling, further drilling to what they call, which is check drilling, which is either twinning or infill drilling in those areas before you can put together certainly a ore reserve. We may be able to get to an inferred resource, which is the lowest confidence level of resource. Sooner. But so that was really going to be part of the DFS, not the PFS. And hopefully it can extend the mine life between 5 and 10 years. And if it does so, that will have a significant impact on the NPV of the project.
Talking of partnerships, there's a question about potentially sharing your infrastructure with third parties in the region. There's a specific question about Eco Metals, which is planning manganese shipments from the region. Is that something that you would consider?
Yeah, because as long as we've got spare capacity, we are designing to keep the capex low at this point in time, designing the capacity of the rail at this point in time to have enough capacity to ship our material, which is going to be about 5.8 million wet tons of iron ore. Previously, they had spare capacity and they shipped, they used the railway and the port and loaded it onto the rail and took that down to Santana. It was shipped out. So previously, yes, they have, I can't remember how much, but it was about 500 to 600,000 tons a year of third-party material, and those third parties paid commercial rates, which is clearly cheaper than using, on rail and port, and are using our port, which is much cheaper than using, trucks and the public port. On
the subject of transportation, there's a question about the shipping and the rising cost of shipping, and obviously that in turn relates to the stockpiles that you want to shift ultimately. So we've got a question: what's the value of those stockpiles, and what's the sort of contingency plan and the impact on sort of financing and funding of not being able to ship that if some of the costs and rates remain unfavourable?
So on a gross basis, which is excluding any costs, the value is 134 million or thereabouts, given current pricings today. However, the shipping costs, as I've said, the impact of increased bunker prices, increased soft commodities, which are taking up a large amount part of the Handymax shipping routes, the war in Ukraine, all have an impact on shipping, and that has meant that it's really not worth shipping at this point in time, given that you've got that fixed price and then you've got the volatility of iron ore, which could mean that you could end up shipping. You might start off with a profit of maybe $10 a ton, when you leave Amapa, but when it arrives and there's a quality change or something occurs in China, it becomes you might lose $5 a ton. So it's not really worth shipping at this point in time. But under, let's call, normal shipping parameters, which is where we typically would see the Handymax and Handymax market go down to, we would see that it was worth around net $25 to $35 million. As to the impact, I think the impact here is going to, what is the impact? Because the shipment of this was to pay the bank creditors. And what is the impact on that? Well, look, within the agreement, there is a clause that a contingency clause which allows us to deal with that matter. However, the agreement, as I said beforehand, between us and the bank is confidential, only because, and I would like to disclose it, but as you would imagine, the bank's reached a settlement amount and certain terms within there, and they are negotiating with other third parties on other, substantially larger debts owed to them, and they don't want, the disclosure of this agreement to impact their commercial negotiations with others. So I can't really disclose it as much as I would like to, but there is a contingency plan in case that we're unable to ship over the 2 years that we look to pay back.
One other question on Amapa before we head on to Sonora, and this is really your thoughts on other transactions that are taking place, or similar transactions that are taking place, and the question specifically refers to a $676 million deal with Sinosteel Corporation by the Cameroon government. What are your thoughts on that, and how it potentially impacts Cadence's value?
So I think obviously it's, how does it relate to Cadence's NPV and its model and its assets? So let's look at some similarities. Well, look, they're going to be doing about 4 million dry tons a year at 60%, and our target's 60% material, which is sort of the lower grade material that would probably selling at the moment about $100 a ton. We're talking about a product of 5.3 million tons, of which 80%, 65, selling at 130, and the remaining being 62, selling at 118 or thereabouts. So, the volumes are roughly similar, but the product mix is different. So our project is better in that sense. However, we don't, however, they have a resource of 628 million tons, which, that rate is a 40-year mine life, while ours is a 185 million tons at this point in time, which is about 15-year mine life. So, they have a much larger resource, so therefore the NPV will be larger. We don't know their capex and opex, but as a new build, it's going to be substantially more than ours. However, I would say that, in my opinion, the Indosino are paying, not Indosino, but the Sinosteel are paying, a Sinosteel Corporation Limited are paying over the market metrics for a project of that size and that stage of development. As how it compares to us, I'm going to point to, once the PFS out, you will see the potential NPV of the project once it gets into production. Of course, the market tends to discount that NPV given how far you are away from production and the accuracy of the study. So DFS, you'd expect a higher percentage being valued at that NPV.
Okay. Thanks. Let's quickly move on to Sonora before we wrap up. I've got a few very specific questions here. One is really, what's your intention for the holding, with specific reference to reports from Benchmark Minerals that Ganfeng have stated they're looking for automakers to take a strategic stake in the project. Are you aware of any discussions around this?
So we're aware of the benchmark report. Obviously, those automakers are having discussions with Ganfeng, which must mean that it's Ganfeng over their areas that they own 100% of. So at this point in time, we're not in those discussions. If, of course, which, there's a mine plan, a DFS mine plan that involves the mine plan out to 20 years, of which we start mining halfway, well, not quite halfway through that, just past halfway through that. So they're going to need to mine from our areas. So we would expect, if that comes to, however, assuming the mine is developed at the same level, we'll eventually need to develop the Mexican concessions and therefore have discussions with us and the development and how they intend to develop our areas. So at this point, there's nothing really to report, and well, let's see what happens going forward there.
Okay, and a second question related to Ganfeng. They've recently said that they plan to produce 50,000 tonnes of hydroxide from phase 1 of the project. How does that affect your mining plans in your areas?
So we base, what we have as a document. They haven't completed a DFS. They haven't completed a definitive feasibility study on this plan. So they are in, our understanding is that they'll be embarking on this to prove that they can do it and that they can deliver lithium hydroxide, which I certainly believe they can from this product, from this ore. And then, what the mining plan looks like. If the mining plan would follow the same logics and economics as the DFS did, then what would happen is that our area would get mined earlier, because suddenly you're not doing 35,000 tonnes of lithium carbonate a year, you're doing 50,000 tonnes of, 50,000 tonnes of lithium hydroxide. So you would see our area come forward in the mine plan, and therefore there would have a far higher value because the NPV would increase.
Okay, and a final question on Sonora, which relates to royalties and ownership. The question is, given the royalties on Sonora do not appear to affect Cadence JV areas, does this make the JV areas more attractive to mine earlier? Would you consider converting your JV holding into a royalty over the areas or the whole project?
So yeah, our areas doesn't have the royalty, and as not having the royalty, it's a lower cost, but it's not enough of a lower cost to make the significant difference to the mine plan. There's a large amount of overburden in our area, so therefore it doesn't make a significant or material difference. It's not going to move it to the year 1 of mining. It might move it by 6 months or something like that, but nothing material. Whether we would convert our JV holding into a royalty over the areas of the whole project, yeah, for the right price, of course we would. As we've shown, we would convert ownerships into many structures, whether that be cash, and more recently, where we've converted our ownership into equity. So royalty or any other derivative ownership of the entire project is fine for us. Thank you very much.
Great. Thanks, Kiran. That's a lot of ground covered. Thank you for taking the time to answer those questions. And thank you, everyone, for sending those questions in. Thank you.
Thank you very much. Pleasure as always.